So let's first of all look at your cost of equity. Remember, you're not going to be given any of these formulae within your exam. I'm not going to go through and derive the formulae like you saw previously in F9. All we're going to go through and do, remember the formula and then work an example. So here we have our cost of equity. Our cost of equity is our dividend today, so D0, divided by my price today. Just remember that price today there needs to be your ex-div market value. Here, what we're going through and doing is we're assuming that we have a constant dividend every single year. So here, this formula at this moment in time is there with no growth. So it's just your dividend divided by your price ex-div. If we look at our example, what have we got? Well, we've got there, we're expected to pay a constant dividend, so no growth. It's going to be there 30 pence per share. And the market price is there £2.30. We're told in brackets that it is cum div, but even if that wasn't the case, we could work it out that it's cum div because that dividend is about to be paid. When it's about to be paid, the price is cum div. Once it has been paid, once it's been declared, the share price drops by the value of the dividend down to its ex-div market value. To calculate your cost of equity, you take your dividend of 30 pence and divide it by your ex-div price. Well, we've got the cum div price at £2.30, so 230 pence. If we strip out the dividend that's about to be paid to get it to our ex-div price, we can work out there that your cost of equity works out at 15%. Nice and simple. Something ever so slightly new, if we go through and issue some shares, what's going to happen there is we are going to have some issue costs. Now all that happens there is that those issue costs are a cash outflow at T0, so in effect it reduces the value of your business by those issue costs. So as a formula, it's just your dividend divided by your price ex-div less your issue costs. If we look at this example here and try and calculate our cost of equity, we can see there that we're going to issue some shares, 40,000 of them, and we're going to finance it there at £2.50 each. So that's going to be the value of your shares. We're then told that there are issue costs of 8%, and we're told there that we're going to get constant dividends at 32.2 per share. So your cost of equity there takes my dividend of 32.2. We take my price of £2.50, so 250 pence, and then we deduct the issue costs. So 8% of my 250 pence. Tapping those numbers into your calculator should bring you to a nice 14%. If we start to incorporate growth into our cost of equity, we end up with your familiar formula for your cost of equity, incorporating growth. So you've got there K is D0 1 plus G over your price, remember still ex-div, then we add on our growth rate. So there G is our annual growth rate, which is there as a percentage. In terms of calculating our growth rate, you've got two methods. What we've got there is, first of all, our historic growth, and then we've got our Gordon's growth model. Historic growth should be nice and straightforward. All we go through there and do is look at our past dividends, see how they have grown, and make the assumption there that what has grown in the past will continue for the future. So if we look at this example here, what we can see there that we have a dividend that has been paid over the last 5 years that has steadily gone through and grown from 180,000 to 280,000. So what you can see there is that you have 1 year, 2 year, 3 years, 4 years of growth in your dividend. To work out the growth rate, your growth rate there is that we take the fourth root of your dividend today, so 280,000, divided by your dividend 4 years ago of 180,000, subtract 1. Tapping that into your calculator, something that I think many students have a difficulty with in the days of F9. Remember trying to work out how you take the 4th root of a fraction. Hopefully you can still go through and remember. Working it out should give you a value there of 12%. If you're struggling, just tap 12% in your calculator and let's move on. So that's your historic growth method done and dusted. Gordon's growth, again, should be familiar to you. R multiplied by B, whereby R is referred to as your return, B is referred to there as your retention. Remember, the return that you generate is there as your profit after tax. As a percentage, that's a percentage on your opening net asset, because that's the profits that you've returned based upon the capital that you've invested at the start of the year. Your retention is looking there at your retained earnings as a percentage of your profit after tax. Now, 2 ways in which that can be examined. 1, you'll be given balance sheet and income statement and have to work out those figures. Or 2, you may just be given the return and given the retention. So if we look at this example here, what have we got? It wants us to go through and estimate our growth rate. And also in this one, it wants us to calculate your cost of equity. So what have we got? Well, we're told there the proportion of earnings distributed is there at 60%. Now, if we've distributed 60% of our earnings, then that must be there that we've retained 40%. So there, what we have is B is equal to 40%. We're told there that the average return on funds is there at 10%. So R is equal to 10. So my growth rate is R multiplied by B, so 0.1 multiplied by 0.4, which works out there at 4%. So that's the equivalent there of 0.04 as a decimal. We're then given the cum-div share price, so we'll need to adjust that to get the ex-div price, and we're told there that the impending dividend, so the dividend about to be paid, is there at 12p. To calculate your cost of equity, we take my dividend of 12 pence, multiply that by 1 plus your growth rate, divide it by your ex-div price, so if we take 108 pence, less my 12 pence dividend to convert the cum-div into the ex-div price, and then once you've tapped that into your calculator, you can then add on your growth rate at 4%. Tapping that in should work out, is that there, at 17%, based upon our growth rate of 4.